They don't call it a return. There is no return policy on a new pickup truck. There is no cooling off period on a car loan. But in 2026, millions of Americans are effectively giving their trucks back. Voluntary repossessions are surging. Repo lots are filling up faster than they have since the Great Recession. And if you bought a full-size pickup in the last 3 years, there is a very real chance you are underwater on that loan right now. Not by a few $100s, by thousands. In this video, we break down exactly why the average full-size pickup now costs almost $66,000, why 1 in 5 buyers is paying over $1,000 a month, how 84-month loans are trapping owners in a cycle they can't escape, and most importantly, how to get out if you're already stuck. This is not a dealership problem. This is not a lender problem. This is a math problem, and the math is breaking bad. Let's be clear about something up front. When you see headlines saying Americans are returning their new trucks, that is not what is legally happening. You cannot walk into a dealership 2 weeks later and hand back the keys like it's a pair of shoes. What is actually happening is a wave of voluntary repossessions, loan defaults, and strategic surrenders that look like returns from the outside. In 2025, the industry saw over 10 million repossession assignments. Nearly 3 million vehicles were actually repossessed. That is a 73% increase in a single year, a level not seen since 2009. And 2026 is tracking even worse. Subprime auto delinquency hit 6.9% in January 2026. That is a 32-year record, higher than the peak of the Great Recession. But this is not just a subprime story anymore. Prime borrowers are feeling it too, because the problem is not credit scores. The problem is affordability. Here is the reality on the ground. Total auto loan debt in the United States just crossed $1.69 trillion. The average monthly payment on a new vehicle reached $772 by late 2025. But trucks are a different animal. Full-size pickups now average nearly $66,000. That means 1 in 5 new truck buyers is committing to a payment of over $1,000 a month. And that is before insurance, before gas, before maintenance. The average loan term has stretched to nearly 70 months. More than 22% of borrowers are now signing 84-month loans. 7 years. That is longer than most people keep a truck. But here is the killer stat. 71% of drivers with 84-month car loans are underwater on their loan. And in the first quarter of 2026, a record 42.6% of underwater buyers turned to 84-month terms just to keep their payments manageable. They are not buying trucks. They are renting payments forever. This did not happen overnight. It started in 2021 and 2022, when pandemic supply shortages sent vehicle prices to the moon. Dealerships were adding $10,000, $15,000, sometimes $20,000 markups over sticker price. Lenders got loose with underwriting. Credit scores were temporarily inflated by stimulus checks and reduced spending. People who might not have qualified for a $60,000 truck suddenly looked great on paper. They signed loans at inflated prices. Then interest rates shot up. A loan that would have cost 5% APR in 2021 was suddenly 8, 9, or 10%. On a $66,000 truck over 84 months, that is the difference between a $750 payment and a $950 payment. Wages did not keep up. Inflation ate into household budgets. And the trucks that were sold at peak prices started depreciating the moment they left the lot. Now those 2021 and 2022 vintage loans are maturing into a market where the truck is worth $20,000 less than the loan balance. That is not a return. That is a financial sinkhole. This is where it gets ugly. Negative equity is when you owe more than your vehicle is worth. Right now, 28% of trade-ins are underwater. The average amount? Nearly $7,000. And here is what dealerships do with that. They do not fix it. They roll it. They take your $7,000 of negative equity and fold it into your next loan. So your new $66,000 truck becomes a $73,000 loan. Then they stretch it to 84 months to make the payment look affordable. According to Edmunds, in early 2026, 90.2% of new loans involving trade-ins with negative equity carried terms of at least 72 months. 43% extended to 84 months. You are not climbing out of the hole. You are digging it deeper. And the data is brutal on this. The Consumer Financial Protection Bureau found that consumers who financed negative equity were more than twice as likely to face repossession within 2 years compared to those who did not. Because when you layer a high payment, a long term, a high loan-to-value ratio, and a stretched budget, it only takes one layoff, one medical bill, one emergency to snap the whole chain. So what happens when the chain breaks? If you stop paying, the lender comes for the truck. But here is what they do not tell you. When a repossessed vehicle goes to auction, it typically sells for about 30% of the original loan value, not 70%, 30%. So if you owed $45,000 on a truck that was worth $35,000 and it gets repoed and sells for $15,000 at auction, you still owe $30,000, plus repo fees, plus storage fees, plus legal costs. That is called the deficiency balance, and the lender will come after you for it. Voluntary repossession is slightly better. You save about $1,500 in repo costs, but you are still on the hook for the deficiency. This is why returning the truck is a fantasy. The loan does not disappear. The debt follows you. And in 2026, with delinquency rates at 15-year highs and climbing, more Americans are learning this the hard way than at any point in modern history. If you are underwater right now, there are ways out. None of them are easy, but they exist. First, stop rolling negative equity. I do not care how good the deal looks. If you are folding $5,000 or $7,000 of old debt into a new loan, you are making the problem worse. Second, if you can afford to, pay down the principal faster. Even an extra $100 a month on a 72-month loan can flip you right side up 12 to 18 months earlier. Third, keep the truck longer. The depreciation curve is steepest in the first 3 years. If you can push to year 6 or 7, you give the loan balance time to catch up with the value. Fourth, if you are truly drowning, consider selling the truck private party. You will get more than a trade-in offer. Use the cash to pay down the loan gap, even if you have to take a small personal loan for the difference. A $5,000 personal loan at 10% is infinitely better than a $73,000 truck loan at 9% for 84 months. Fifth, going forward, follow the 20410 rule. 20% down, 4-year term maximum, 10% of your monthly gross income maximum for the payment. If you cannot hit those numbers, you cannot afford the truck, period. The 2026 truck market is not crashing because of bad trucks. The trucks are fine. It is crashing because of bad math. $66,000 averages, $1,000 payments, 7-year loans, record negative equity, and a repo rate that has not been this high since 2009. If you are in this situation, you are not alone. Millions of Americans are feeling the same squeeze. But the way out is not another rollover. It is not another 84-month term. It is stopping the cycle, owning the truck instead of renting the payment. Making the hard choice now, so you are not trapped for the next 7 years. If this video helped you understand what is really happening out there, hit the like button and subscribe. And if you are dealing with an underwater truck loan right now, drop a comment below. Let us know what you are facing. The community might have answers. Until next time, drive smart, buy smarter, and never let a payment own you.